How you guys doing? Josh Crow here, and today we're going to talk about how you can reduce your tax liability throughout retirement. I spent the first 10 years of my career in taxes, and so I feel pretty comfortable with the topic. For those of you who've been to my channel before and newcomers, well, welcome. If you guys could subscribe to the channel, that helps me further the education to continue providing you guys with great content here on the channel. So I'm going to start with a different type of tax you can expect to pay during your retirement. Then we're going to talk about averages. How much can you expect to pay on average to the federal, the state, and so forth? And then lastly, I'll give you guys 5 strategies you can implement today in order to reduce your lifetime tax liability. So let's start with the most general type of tax. Most of you would be familiar with federal income tax because anybody who has ever worked in the states has had to pay federal income tax. Now, for retirees, you are likely to pay federal tax as well because you'll collect pensions and Social Security, and most of those will be taxable. Now, the next one up is state tax, and that depends on where you are living. Obviously, I'm here in California, so state tax is really high. Some states like New York have a higher tax rate than even California, but they are kind of at the higher of state tax. Some states you don't even have to pay state tax in, so it really depends on where you're living and taking your income. The next one is going to be local tax. Now, local tax consists of your property tax. That could also consist of your sales tax. Things of that nature. Could be licensing for your vehicle, like vehicle registration. So there is a variety of different tax you'll pay at the local level. And then lastly, we have FICA taxes. Now, some people think, well, Josh, we're retired now, so we won't have to deal with Social Security or Medicare tax. Now, that is true if you're fully retired, right? But for those of you who will continue working maybe a part-time job who don't fully retire, you will have to continue, whether you're collecting your benefits or not, you'll have to continue paying your Social Security tax and your Medicare tax. So those are the general types of taxes you can expect to pay during retirement. What I'm going to do now is I'm going to focus on these first two, and we're going to walk you guys through an average, what you can expect to pay at the federal and state level. So the benefit to figuring out an average is so that you can calculate your net monthly income. Second of all, it's going to help you set kind of a barometer. In order to lose weight, we first have to step on a scale, right? So that kind of sets the goal out in front of us. And then I can give you guys an education to help reduce whatever that percentage is. So if we know we're starting at 20%, well, hey, here are some things that we can do to reduce that by 2%. Now we're down to 18%. We can just simply apply that same number to our gross monthly income, and we can start to see how much we'll save over our lifetime. So with that said, let's go ahead and get a short education on the difference between effective and marginal tax rates. So I went ahead and Googled around and found the 2022 Married Filing Joint Tax Bracket on the Forbes website. And this definitely looks more complicated than it is. If we assume you have $100,000 worth of taxable income, so after your deductions, if you had $100,000 to be run through the tax tables, let me show you how it works. It's pretty simple. The first $20,550, if you're married, would be taxed at 10%. So we might have something like this, where you have the first 10% would be, let's say, $20,550, and that's going to be multiplied. We'll just put a star there for multiplication, or we can do an X times 10%. That equals 2,055. Okay. Now I'm going to go ahead and do that. We'll say out here that this is the 10% bracket. So this is the 10% bracket. And I'll just shrink that a little bit so it's easier to see. And I'm going to go ahead and do that for each one. If I go back, what we'll notice is from 20,550, but not over 83,550. So that portion is taxed at 12%. So the 20,550, what we'll do in taxes is we take the 100,000, right? And we subtract 20,550 because you've already paid. We already wrote down the tax that you owe for that first $20,000. It was 10% or $2,055. So we subtract that from the $100,000, and then we look at this bracket here, and this bracket is up to 83,550. Now we don't go over 83,550. We're at 79,450. which means that all of this remaining balance here, the $79,450, will be taxed at 12%. So I'm going to go ahead and jump back to our little worksheet here, and we'll say that 12%, and that was going to be 79, whatever's on our calculator, 79,450, 79,450, and that's going to be multiplied by 12%. Pull up a calculator again, and so we have 79,450 times 12%. And so the tax liability, how much tax they owe on the 79,000 is 9,534. 9,534. Okay, so the total tax on the total Fed tax is equal to the 9,554 plus 2,055, 11,589, 11,589. Okay, and their marginal tax rate equals, it's where their last dollar was taxed, and the last dollar taxed is right here at 12%. They didn't make it into the next tax bracket. So their last dollar that they earned or taxed that landed at 12%. So their marginal tax rate is 12%. What about for those of you who make more? Well, you'll just continue down to the next tax bracket from 83,550 to 178. That'll be 22%, and then so on and so forth. Now, wherever you end up, remember, that is your marginal tax rate. But that doesn't give you an average. That's what we're going to talk about next. The average, or otherwise how much tax you pay per dollar you earn, is what's known as your effective tax rate. And it's actually pretty simple to come up with. All we have to do to get our, and I'll write it down here, effective tax rate, for this example, is take the total tax that they have to pay, the $2,055 from the 10% bracket and the $9,534 from the 12% bracket. It's not 22%. Adding those together would give us 22%, right? Pull up a calculator. I think that's pretty easy for us to see. We know that we first 20,000 was at 10, and our next 80,000 or so was at 12. Some people might think, oh, my effective tax bracket is 10 plus 12. It's not 22%. That's not the average. You also wouldn't take those two and divide it by 2 for 11%. Some people think, well, if I just add the two brackets together, right, the two percentages together, and divide it by 2, since there are two brackets, then I'll know what my average is. That is also false, because more money ended up in the 12% than the 10%. It's what they call, it's not weighted correctly. So all you have to do, it's pretty simple. You just take that bottom line number, the total federal tax, and you divide it by the amount that you earned, the taxable amount, your taxable income. So if we pull up a calculator, and we started with $100,000, so we do 11,589 divided by 100,000, 11.589. So we'll just round up, 11.5, and we'll go 2 decimals. So 5, 9. Well, that'll be 11.6. So your effective tax bracket ended up being 11.6%. So on about every dollar more you earn, or every dollar that you did earn, you're paying about, call it 12 cents if we round up, about 12 cents per dollar. So your objective should be to try and reduce that 12% down by as much as you can. Even 1%, 2% is a lot, because that's on a very large amount, $100,000. 1% of 100,000 is 1,000. So for every 1% that you can save here, well, you're saving $1,000 per year, and that over 25 years ends up being a lot, especially if you were to invest that money. So let's move on to state tax next. Now, dependent upon the state you're in, your tax rates will be different. The brackets and the rates will be different, so you're going to want to check to see what yours look like. But this is for California. Theoretically, they all work the same. If you're fortunate enough to be in a state that doesn't pay state tax, well, I guess you could just fast forward through this section. But it's really very similar to what we saw with the federal tax. So if I jump over to nerdwallet.com and we look at a California state tax bracket for married filing joint couple, I mean, look at the format. It's almost the same as what we saw with the federal tax bracket, right? So here it's a little different. It's from 0 to $18,650. That's going to be taxed at 1%. So if I come back to our little worksheet and I say we're talking about the 1% first tax bracket there in the state, on the state side, So we're talking about the 1% of the California state tax bracket, and where it says up to $18,650. So I'm going to say $18,650 multiplied by 1%. And we figure you can use a calculator if you need to, but that's 186.50. Okay, and so now moving on to 2%. So for 2%, it's a little bit more challenging. We know that our $100,000 of taxable income is going to end up way down here in this 8% tax bracket. So what we're saying now is anything from $18,651 to $44,214 of that $100,000 taxable income is now subject to 2%. So the way we do that is we grab a calculator. 44,000, this is the upside, kind of the upper end of this tax bracket. 44,214 minus what we've already paid tax on, 18,651. That's 25,563, and that's going to be subject to 2%. So if we go back to our worksheet here, this is going to be 18,000. This is going to be the 20. This will be 25,000. This will be the 25,563 multiplied by 2% equals, if we grab a calculator to do that. Hey, I use a calculator all the time. So, even though I'm a finance guy, 563 is better to be safe than sorry. 2%, 511.26. So now we go 511.26, and we're going to move on to the 3% bracket. I'm going to go ahead and run through these really quickly so that you guys can kind of see the total here at the end. All right, so now that I have the tax for all of those brackets, I just have to total them up. So let's just grab a calculator and get a grand total here. So we've got 186.50 plus 511.26 plus 1,022.76 plus 1625.10 plus 250.32. Total state taxes $35.95. Total California state tax equals $35.95. $35.94. All right, and then the marginal tax rate, what do you guys guess? Where was our last dollar? Boom. So our marginal is 8% on the state side, and then our effective tax rate. Did you figure that one out? I'm taking a pause for a moment to see if you can remember. $35.95 divided by 100,000. So it's not, some people again think, oh, we'll just, because we made it all the way through these brackets. First of all, they'll think they're either 8%, and they'll confuse the effective tax rate, the average, with the 8% marginal. Or they'll add all these up because they know that their dollars were taxed through all those tables, and so they'll add these up and divide it by the amount of tables. So, 3, let's see, that's 2 plus, the 1 is 3 plus 4 is 7, 7 plus 6 is 13, and 13 plus 8 is 21. And then what they'll do is they'll take 1, 2, 3, 4, 5, divide 21 by 5, which is, I don't know, a little over 4. So they'll think their average is about 4%. Let's find out what it really is. The way we do it is the $35.95 worth of tax that we paid, the total tax for all these brackets, divided by the $100,000 that we were taxed on. It is 0.035, so 3.59, 3.6%. 3.6%. And now we see, and $100,000, I mean, I would say that that's quite high for your average retiree. That's probably in the mid-high for your retirees. So, we're looking at 11.6 plus 3.6 for a total between Fed and state tax. 3.6 plus 11.6 of 15.2. Pretty low. So how do taxes work for those of you who are not living in California, say one of the other 49 states? And I have this article up by Kiplinger, and I'll be sure to post the link inside the description below, but it shares with us how much tax you can expect to pay in any of those states. And so if we scroll down to the first one, we have Alabama. And this here, this first description, state income tax range, that's that bracket that we saw and work through on the California side of things. So you'd have to find or work your way through that same one. But this is what I kind of look at for a quick reference, is that average combined state and local sales tax rate, 9.24%. And that gives us a pretty good indication of what we can expect to pay between state taxes and sales tax. And those are going to be, combined with your federal tax, the bulk of the tax you'll pay in retirement. So if we take that 9.24 and we add it to this person's federal, remember this was a couple earning $100,000 a year. That was their taxable income, I should say. And we had 11.6 plus 9.24. They can expect to that the majority of their tax to be paid in the state of Alabama would be about 21%. Now, this is excluding property tax, which should be identified here because it is or tends to be one of those higher taxes, but everything else is pretty minimal in comparison. So this might move up to 22, 23 maybe with property tax. But you're looking right around 21, 22-ish to live in Alabama. Now, obviously, that was lower. You know, we came up with 15.2 in California. That's because we didn't include sales tax. And in my county, about, call it 8%. Let's see, Newport Beach sales tax rate. And that is 7.75. Okay, so really, if you want to do apples per apples, so we had about 21 in Alabama. So we would do 3.6 plus the 11.6 plus 7.75. We're at about 23. So it's 2% less to live in Alabama. Now, going back, again, I'll post that article for you guys. You can just keep moving down the screen here, the article, and you'll find Alaska. It's about 1.76. And so on and so forth. I mean, it's every state, all 50 right here. And I would, again, take a look at what the average combined state and local sales tax rate is and then add that to the federal tax. And you should have a pretty good idea of what it costs to live there. You know, it's funny enough, I'm going to go ahead and delete a few of these so we're just left with the effective tax rate. It's funny enough because I was talking with a client the other day and they says, you know, I really am thinking about moving out of California because I want to avoid paying all the state tax. And I says, have you ever figured out what your effective tax rate is? No, I don't, but everybody says it's really high. I says, well, you know, on average, it's, you know, anywhere from 4 to 6%, which is, if you think about it, based on their earnings, I think he had like $60K a year. It wasn't a whole lot. You know, you might pay a couple grand, maybe $2,000-$3,000 per year to live in this beautiful state. And so he says, yeah, it's really not worth it. It's like, I'm not going to move out of the state to save myself $1,500 or $2,000 per year. And for some of you, maybe that's the case and you would. And so no offense to you, but, you know, I don't think that majority of people would make their decision to uproot out of the state over a couple $1,000s. Moving right along now so that we have an idea as to what we're paying the 15.2. I'm going to go ahead down here and for local, this should have just kind of been pushed out like that. And we'll say property tax, I'm going to just kind of leave that off for the moment, assuming maybe you're a renter. Sales tax, we know was 7.75%. And these other smaller ones I'm going to forget about. Even FICA I'm going to forget about, and our total in California. So total Fed, California, and sales tax, the biggest here is going to be, what do we say, 22.95. 22.95%. So now, the question is, how can you reduce that 22.95%? Because if we think about it, like I said earlier, on that $100,000 of taxable income, if they're paying 22.95%, that's 22.95%, that's $22,950, call it $23,000 they're paying or giving to the government every year off of that income they're earning. If I divide that, let's divide it by 12 because a lot of us think in months. That's almost $2,000 a month. So the question then becomes, how can we reduce that tax liability? And I have 5 different ways, or strategies, I should say, in order for you guys to reduce those taxes. So let's jump over to that next. So in the presentations I do for prospects and clients, I have these 5 strategies that you can implement to reduce your tax liability. And the first one is going to be seeking long-term capital gains. Now, when you sell an asset, the difference between the price you bought it for and the price you sell it for will create either a capital gain or loss. Now, if there's a gain, you will pay tax dependent upon how long you own that asset, right? So if you owned it for less than a year, then you will pay short-term capital gains. If you owned it for more than a year, you'll pay long-term capital gains. Long-term capital gain tax rates are more favorable than short-term, and let me show you what I mean. Here is the tax bracket. It's very similar to the one we looked at earlier. As a matter of fact, this one on the left is exactly the same, other than it's from the year 2021. So the numbers are just slightly less. But it is the married filing joint tax bracket, ordinary income tax rates. And anything held and sold and gained on less than a year is going to be exposed or subject to this bracket here. Now, if you hold and sell beyond a year, it'll be subject to these more favorable tax rates on the right. We can see that if you have an income as a married filing joint couple from $0 to $80,800, you'll pay 0% capital gain tax. From $80,000 to $501,600, it's 15%, and then anything over $501 is 20%. So extremely favorable in comparison to those ordinary income tax rates, especially since you have to be over $80,800 in taxable income in order for that to even start. That is the reason you want to focus on long-term capital gains. So now that you understand the difference between short and long-term capital gains, I think it's a good time to take a moment to look at how different types of income are taxed and which ones you should focus on. So the first ones we have up are income tax at ordinary income tax rates, the left side less favorable tax brackets. So any type of earned income, including your wages, salaries, or tips, right? This is majority of working Americans, the type of income they'll receive. Social Security, pensions, interest, annuities, ordinary dividends, short-term capital gains, unemployment, rents received, royalties and partnership or business income, withdrawals from retirement savings accounts, including 401ks, IRAs, 457 plans, SEP simples, doesn't matter. All of that retirement savings, those deferred tax accounts, are taxed at ordinary income tax rates. Now, what about more favorable types of income? So we have long-term capital gains from the sale of stock, home, or business that were sold or held for more than a year, qualified dividends and some securities that meet special regulations, sale of highly appreciated inheritance for step up in basis. If your parents owned a home that they bought for $100,000 back in the 70s, and now it's worth, $500,000 and you inherit that after their death. If you sell it when you inherit it for $500,000, there's no tax to be paid because you got a step up in basis. Tax-free investments, including municipal bonds, tax-free ETFs, and Series I bonds and other bond types. These are the types of incomes that you want to focus on to bring your effective tax rate down. Strategy 2 is about structuring your retirement income. Where you take your income from to supplement your pension and Social Security matters. So we have something called liquidity priority, and that's what you want to follow, starting with your cash first. Then you'll move on to non-qualified brokerage accounts, the ones you pay tax on annually as you or your advisor are making trades within those accounts. Next up, 401ks and IRAs, SEPs and simples, anything that's deferred tax. And lastly, we'll save Roth and any cash value life insurance for the very end of retirement if we can, because we assume that taxes will continue to increase. Also, those are the best types of investment vehicles to leave your heirs. Next, we want to focus on reducing our need for income, and that seems obvious, but the reason is because most of you will be taking the supplemental income from those 401ks and IRAs, which is those are highly taxed. And so by reducing our need for income, we will need less from those highly taxable accounts. And then lastly, pay off or down your debt. Again, this seems like something that would be intuitive or obvious to us, but the reason why is because paying off that $100,000 the mortgage payment that you have from your savings account, a lot of people, what they'll do is keep savings, and then they'll take down from their 401ks and IRAs enough to cover the mortgage. there's a lot of tax there stuck in between. They're better off taking and applying that savings account to the mortgage, getting the house out of the way. And I can promise you, after doing taxes for 10 years, that the amount you're receiving, if any, as a write-off or deduction on your tax return is not even close to the amount of savings that you'll achieve by simply getting that out of the way and stopping or reducing the amount you're taking from the 401ks and IRAs. Strategy 3, picking the right investment, has a lot to do with how you organize your portfolio, where you invest, and how you distribute from that portfolio. Starting with asset allocation. In your brokerage account, the one that you'll typically pay tax, short-term tax on anything that's sold within the year, if there's a gain, or on interest or dividends received, you want to make sure equities held for more than a year are in that account. In your 401k or IRAs, any fixed income securities, including bonds that are going to pay interest, preferred stock that are going to pay dividend, any stocks you plan to trade within the year, you're going to want to keep there, because everything inside the 401k is taxed at ordinary income tax rates anyways. It doesn't matter if you sell within the year or not. The next one is holding securities for more than a year in that brokerage account. So it's a buy and hold strategy, regardless of what your advisor or anybody else tells you, really, in that brokerage account. You want to make sure that you're holding for at least a year there, because you're going to save yourself quite a bit on tax. You may not have to pay any tax, as we saw for, married filing joint, up to $80,000 of income. Next, we want to be choosing tax-efficient investments. So inside the brokerage account, making sure that we're purchasing municipal bonds and I-bonds and tax-efficient ETFs, things that are going to produce a much lower tax burden, especially if you plan to be selling within the year on your brokerage accounts. Roth conversions, that would be for somebody typically who is retired and now they're going to be in a very low tax bracket. They're going to have a very low effective tax rate. Might consider starting distributions from their 401k and IRAs at that lower tax rate, assuming that tax rates in the future are going to increase. They'll pay the much lower rate of today and avoid that higher rate of tomorrow. And lastly, we have loans against your assets, including cash value life insurance or even the equity of your home when it makes sense. That can help you reduce your lifetime tax liability, because as long as it's a loan and you're paying it back, well, then you don't have a taxable event. Next up is tax credit strategies, and there are two types of credits, non-refundable and refundable, and you always want to focus on refundable. Refundable credits will give you a refund, I should say, beyond your tax liability. So as an example, if you have a non-refundable credit we'll start with, and you have a tax balance of $5,000, but maybe you put up solar, or you have energy efficient windows put in and a $10,000 credit, you're only going to zero your tax liability out. It's a $5,000 tax liability that you owed, so it was negative $5,000 on the year. You had a $10,000 credit. It'll only help you up to the $5,000 negative balance. So you owe zero for the year. However, if you had a refundable credit instead, let's say that solar was refundable, and I believe most solar is non-refundable. So maybe like an electric vehicle, because I believe those are refundable. For the same $10,000 and you owe $10,000, you'll get a $5,000 refund, because it'll take care of the $5,000 that you owe, but then because it's refundable, it'll also give you the other half of that $5,000, and you'll have a nice refund. So focus on refundable credits. We also have a list of others here. Hopefully you guys can see those. I'm only going to focus on two, and that's if you have like grandkids living with you. You can receive a child tax credit or earned income credit if you meet the requirements. But then also if they're attending college, there's an American Opportunity Credit as well that's available. Now, the last one are these tax-efficient trusts. For people who are looking to reduce their tax liability, they can move some of those assets into a trust. And kind of the loose idea is that when you die, those assets will be given to like a charity of your choice. And provided that the charity is the beneficiary of that trust, you can get tax breaks as you're taking income from that trust. So they'll reduce the tax that you have to pay, or in some cases even eliminate that tax. So that's number 5 for you. As a recap, we learned that a retiree living, say, in California is going to have a federal and state combined effective tax rate of about 15%. Now, you smack sales tax on top of that, and we're looking closer to 22, 23%. So the idea here is that given you're going to give up at least a quarter of what you earn in retirement to taxes, that you might want to implement some strategies in order to reduce that bill. With those 5 strategies I talked about today, and been able to save clients from 5, I'd say, to 8% slashed off their tax bill by implementing some of those strategies. A lot of it has to do with paying off debt, believe it or not. I know the CPA is going to tell you to hold on to that house because we got to use it as a deduction. I'm telling you, most of you aren't even filing a long form or using that deduction, those itemized deductions anymore. Majority are taking the standard deduction because for a married filing joint couple, it's so high nowadays that it doesn't make sense to use your itemized deductions. They're less than that amount. The other area is going to be spending less. I know that that sounds intuitive, but I'm telling you, if you can just buckle down, take less from those 401ks and IRAs, you're going to save yourself a lot on taxes. Another worth mentioning is your Social Security, the taxable amount, is dependent upon how much income you earn. So if you're paying off debt or you're spending less, you'll need less from those retirement accounts. Your income will be lower and the tax on that benefit will be lower, and overall you'll have a lower tax year. Some of the other areas to consider would be like credits. I love credits. I've been a big fan of them ever since I did taxes. So keep your ear to the ground, talk to your CPA, look for tax credits, and you want to focus on refundable ones. And then lastly, and probably just as important as everything else, is making sure that the portfolio you have, your 401k, your IRAs, your retirement savings, your Roths, are all set up in a fashion that the brokerage account isn't holding things that you're going to have to pay tax, those short-term capital tax rates on. That it's set up in a fashion that you're going to be buying and kind of holding those assets for more than a year if you're going to sell them. And then anything that's going to produce or be traded within the year or produce an income or a dividend, that be placed inside the 401ks. I promise if you're implementing a few of these things, small tweaks and changes, you'll see at least 3 to 5, upwards of 8% tax saving on an annual basis. Thank you guys so much for tuning in. If you haven't subscribed to the channel, please do so because that is what allows me to continue making this content.